This is the Everything Financial Radio program. We are here every week at this time. I am your host, Dennis Tubbergen. I'm glad you decided to tune in today. I have a terrific show lined up for you. Best-selling business author and economist Harry Dent will be joining us today. We'll ask him about his new book, The Demographic Cliff, to be released later this year. Also get his perspective on what's going on. Will the Federal Reserve actually quit easing as they're talking about, or at least taper the easing, and what will be the effect on you and your money? Also, I'll talk about the biggest increase in employment in an age group. The answer may surprise you, that on the last segment of today's program. And the Federal Reserve now owns more than $2 trillion in U.S. government debt. Can the trend continue? I will talk about that in the second segment of today's program. And are banks today in better shape than they were in 2007, or are they in worse shape? The answer may surprise you. We'll talk about that on the second segment of today's program as well. Before I get to my conversation with Mr. Dent, let me remind you, if you happen to miss an interview with one of our guest experts, you can simply go to the iTunes store and search under Everything Financial Radio, or you can go to everythingfinancialradio.com. The interviews are posted there, typically a couple days after they air. Also, quick reminder, if you've not yet attended our new retirement rules class, let me tell you just a little bit about it. It is a 3-night class. The cost for the class is $49. It covers all the handouts in the book that you get for attending the class. It is held out at the Western Michigan University campus on the East Beltline. Happens from 6:30 to 9 o'clock, 3 Thursday nights in a row. We give you a lot of information, but most importantly, talk about what does today's economy mean potentially for you and your money, and what should you be doing to maybe protect yourself and even position yourself to prosper for what may lie ahead. We also talk about the best ways for you to collect Social Security. That's a relevant conversation if you're between the ages of 55 and 69. So I'd encourage you to go to newretirementrules.com and get more information, or to register while capacity remains. September 11th will be that next class. The website again, newretirementrules.com. I'm pleased to have back on the program today Mr. Harry Dent. Harry is a nationally known economist and best-selling author. He is also the publisher of the Survive and Prosper newsletter, which is a free publication you can find at harrydent.com. And Harry, welcome back to the program.
Nice to be back, Dennis.
Harry, I was listening this morning to Bloomberg Radio, which I do occasionally, and an economist that I will not name said the economy is growing at a slow but sustainable rate, and the employment picture is set to improve much more dramatically than many think. What are your comments?
Well, sustainable is ridiculous. The only reason we're growing, and I mean the only reason by far, is $2 trillion worth of stimulus a year, $1 trillion in monetary policy, QE, and about $1 trillion on average in the last 4 to 5 years in fiscal deficits. If we did not have this stimulus, not to mention other bailouts and things, there's no way we'd be growing at 2%. Think about it, $2 trillion a year. That's like 15% of our GDP to get 2% GDP in growth. What business, what bank, what anybody, investor, would make that horrible bet? So to say it's sustainable, I say anybody thinks this recovery is sustainable, stop the QE for just 12 months and see how fast we go into a deep recession. So this is not sustainable. The fact that we're only getting 2% growth with such massive stimulus shows how weak the growth is. We would have negative growth without a question without it.
Harry, I want to talk a bit about that because in one of your recent Survive and Prosper newsletters, and I'm just going to give a few sentences from it, you wrote, when I came out with the book, The Great Depression Ahead, in late 2008, I had no idea central banks around the world would pull out all the stops and commit to endless quantitative easing and a money printing policy. You went on to say, I did not expect 5 years and over $10 trillion in money printing globally. Well, the Fed now is talking about tapering the money printing. Given the circumstances economically in which we find ourselves, do you think they will?
It depends. I mean, if the economy keeps going like this economy, and the job growth is pretty good, about 190,000 a month on average. It's better than the GDP growth, and that's a little bit hard to understand. But yeah, if we keep going at this rate, yeah, they'll have to taper. They've already said they will. They only won't taper if the economy starts slowing, and I think they may not taper if housing starts to slow, I'm looking at housing because that's been heavily driven by speculation and investors, and they may be starting to back off, and if they do, housing may slow, and that could change the Fed's mind. But to me, either way, they're being checkmated here, as I've been predicting would happen. That's why stimulus doesn't work forever. If the economy does get a little better, they're going to have to taper, and without the stimulus, the economy will eventually fail again. If the economy doesn't get better and starts to slow despite the stimulus, then it's showing that the stimulus is no longer working, and that's another principle of stimulus. It's like a cup of coffee. It works short term, but it doesn't work long term because you can only stretch an economy that's overstretched so far. So I think either way, the Fed's in trouble, and they're not going to be able to keep escalating stimulus, or they're going to be forced to taper back. And then, oops, without the stimulus, we got nothing.
You know, Harry, it's interesting because the Fed, according to an article this past week in CNS News, now owns more than $2 trillion of U.S. government debt. If the Fed stops printing, and, you know, it wasn't that long ago that Bernanke hinted they may taper on the printing, interest rates spiked. Doesn't that put the Treasury in a box in that we've got all this debt and they can't possibly afford to finance it at a higher interest rate?
Yeah. Again, they've been borrowing from the American public by pushing long-term interest rates down. That means savers can't make money, or they have to go into riskier assets, which means they're going to get killed in the next crash if they did that. So they've been basically taking from people to put money in the banks and keep the banks from failing, and to push interest rates down to keep their borrowing down. So you don't get something for nothing, as all good business people know, and most people with any common sense. So when you start pulling out this stimulus, you get a boomerang. Interest rates are going to spike back up, and they may even spike higher than they would have been, and we're going to have to see a 10-year Treasury bond at 3.5% to 4%, maybe even 4.5%, and then mortgage rates already gone up over 1 percentage point. What happens if they go up 2 percentage points or so? I saw some today. Average mortgage payments gone from $566 to $766, up a third in just 3 months because of the spike. What if it goes up again, and now it's near $1,000? Somebody's interest rates have gone up like 60, 70, 80%. They're on their mortgage payment. That is going to hurt the housing recovery, and that's going to hurt households, especially young households buying homes, and they're already scared to death to buy a home.
Harry, just listening to you, it sounds like you would have some bearish news for those investing in 401ks and IRAs out there. It sounds like you're not very bullish on either bond mutual funds or stock mutual funds. Is that the case, and why?
Yeah, eventually bond funds, if interest rates continue to spike up to maybe like 4% or 3.5% on the U.S. Treasury, then we say, bond funds might look pretty good from there because we do see deflation on the road. But stocks do not look good here. They have not peaked yet. I'm looking for a peak maybe around January, a little, several months from now, around 16,000 or a little higher on the Dow. We get there, you need to get out of stocks. We've seen bubble burst, and it's going to happen again because this whole recovery is artificial. The whole stock market boom is artificial. It's all fed by stimulus. When the stimulus either stops working or is forced to be tapered, stocks are going to go down. And the trend has been a higher high, which we've gotten now and we'll get, and then every crash has taken us to a lower low, the 2000-2002 crash, and then a lower low in the 2008-9 crash. And I think the Dow could be at 5,000 to 6,000 in just a couple of years. So, yes, it's time to get safe, especially by the beginning of next year.
Well, Harry, I was just going to talk about that higher high and lower low. Is a 5,000 to 6,000 range on the Dow your ultimate bottom as far as what your forecasts and models are telling you?
Well, our models are saying all of our key cycles, our kind of 10-year cycle, our spending wave, demographic cycle, our geopolitical cycle, all point down together for the first time from early 2014 into late 2019. So this is probably going to be a couple of crises ahead. And I think ultimately the next stop on the Dow is probably about 5,800 to 6,000. But after that, down around late 2019, early 2020, when I think stocks could bottom long term, it could be as low as 3,000 to 4,000. That would erase the whole bubble back from the tech bubble and started in late '94, 3,800 on the Dow. So somewhere around there, 3,000 to 4,000, we could be the ultimate low. But I don't see that low in the next crash. But I think most people agree 5,800 to 6,000 is enough to be scared about.
Absolutely. And in the next segment, we're going to chat a bit more with Harry Dent about the geopolitical cycle, the spending wave cycle, and the commodity cycle. I found that fascinating in, Harry, your latest Survive and Prosper newsletter. If you're just joining us, we are chatting with Mr. Harry Dent, publisher of the Survive and Prosper newsletter. It's free. It's available at harrydent.com. We will continue our conversation with Mr. Dent in the next segment when Everything Financial Radio returns. Hope you'll stay with us.